Welcome back to Taxes and Retirement, Risk, Fees, and Taxes. I'm Imran Razvi. I go by Raz, and this is Daniel Razvi. He's a tax attorney, and we want to shed some light on some different things that keep popping around all over the place.
If you want to reach us, you can go to our website, which is riskfeestaxes.com. Again, that's riskfeestaxes.com.
So right now, I want to bring up, I hear this a lot of times, is that you can get your 401k and make it a self-directed IRA. And that's so cool because when we have self-directed IRA, you can buy real estate, you can do a whole bunch of great, cool things. And, buy gold and silver in the IRA, and you can buy real estate. Real estate comes up a lot. And we've had a personal experience just recently with one of our clients, that new clients we just got, and they had a problem. What happened?
Yeah, this client came to us and he already had an IRA was worth $2 million. And he and
his wife's mostly, right?
Yeah, he and his wife they actually each had it, but but in the wife's IRA, there's $2 million, and it's in real estate already. It's self-directed, and he's bought into this idea. This is going to be great. He's been getting regular income from this, and it's just been building back up into the IRA. Then he bought another property, so now the IRA is worth $2 million, and they have two properties in it, so they're each worth about $1 million. Well, the problem is, RMD age is coming up. Now, what does RMD stand for?
Required minimum distributions. That means that at a certain point, if you're close enough to 73, at 73, and if you're under 65, then it'll be at 75. That's when the government says, okay, all the funds over, and you got to now take your money out, whether you want to take it out or not. You got to start taking money out and pay taxes. And there's a formula.
Yeah, so they take a certain amount every year, depending on what the IRS decides how long you're going to live, and then they do that.
And they're pretty generous. They give you at 73, they give you 26 years, so it's 99 years old. They don't think you're going to live 99 years. They just want you to pay taxes for the rest of your life. And then when you die, you want your kids paying taxes.
So we used to talk about the dangers of self-directed IRAs in real estate on this program a lot. We've actually had quite a few segments about it, and we used to highlight these things are all still true, that it's a problem to have your IRA in real estate because the kids don't get a stepped up basis when you die. So with
low step basis means that when they inherit it at the current value, and there's no capital gains tax.
Right. So real estate is great to own if it's outside of an IRA, because when you die, your kids get it all tax free for the most part, and they can depreciate it all down again. And then the other big danger is if you need a lot of maintenance costs, like a new roof or something, you're not allowed to contribute to the IRA more than $7,000 to $8,000 a year. But you have to borrow, or you can't get a good loan because it's an IRA, and so on and so forth. And so those are the things we highlighted in the past. But this client came to us and for the first time, and they said, well, our RMD age is about to hit. Well, this creates even the worse problem, because they realize that the first required distribution from this IRA is more than the total income before expenses from the rental property. That means there's not going to be enough cash in this IRA to pay the first required distribution, which is only 4% or so. But the properties are not making $80,000 of income after after expenses, and not even really before expenses. So they're realizing basically the IRS is going to require them to sell one of these properties.
Even though they like the property, they don't want to sell it.
And it's not a good time to sell for the market they're in, the state they're in.
So they said, well, can we buy it from our IRA? No, you can't. It's got to be arm's length.
Yeah, well, let's buy it for lesser value. We'll sell it to our son. No, it's not possible. And so the IRS is going to force this couple who thought they were doing a great job originally to protect their money from taxes with an IRA, but it's a myth. The IRAs and the 401ks are some of the biggest scams in the IRS code, and I say that kind of tongue in cheek. It does what it says to do, right? And somebody was saying to me the other day, this is kind of unrelated. It's on the drug problem in America. He said it's not that drugs don't work. It's that they do work, and they cause that feeling that people have in there that they want them to do more. Same thing with IRAs. IRAs and 401ks are kind of like that. They're kind of like drugs. It's not that they don't work to defer taxes. Right. They do work to defer taxes.
Exactly.
And that's the problem. It's not a feature. It's a bug. And when you defer taxes for years and years, for decades, someday you're going to have to pay those, and you don't get to do it on your schedule. So if you're listening to this program and you have a few years left before required distribution age, you really should talk to somebody about how to get out of that partnership with the IRS. You got those handcuffs that you have to pay the tax when they say if you wait too long.
So basically, for this client, I mean, they're forced to sell this house. They didn't want to sell it, and they thought, well, maybe we can just sell it to our son at a lower cost or buy it ourselves. They can't do any of that stuff. Your hands are tied. There's too many restrictions when you do it involve an IRA.
Now, were they required to actually cash it out and spend $1 million in taxes today? No, but they had to sell the property, and so not the right time to sell. They're going to have to sell quickly to be able to come up with the money.
Yeah, as they're coming up on their 73rd birthday in just a few weeks. So it causes lots of problems, lots of stress. And your retirement shouldn't be stressed. So that's one of the things is we want to uncover a lot more information so you don't have these stressful problems in retirement. That's the wrong time. You should be enjoying retirement, enjoying the money you've saved up, the lifestyle you want to have, and not have these complications and problems.
So go to our website, which is riskfeestaxes.com. Those are the 3 biggest killers in retirement. Riskfeestaxes.com. And you can schedule a free call with us to find out what is the way that you can reduce your risk, fees, and taxes, particularly if you have an IRA or 401k deferred money. You want to see what's the best way to minimize those taxes. Or maybe you have a business and you're trying to sell the business and you want to know how that tax consequence is going to be there. Talk to our tax attorneys. That's one thing that makes Higher Ground unique is it's not just an advisor you're talking to or a retirement planner you're talking to. And it's not just an attorney. It's the retirement planning and the attorneys in the same house that are both client facing.
Yeah, I mean, out there's so many people that want to give you advice. They want to talk to you. They know all these things, and they probably don't have the same problems you do, but they absolutely are certain they know what to do, and they would love to give advice. And many of them give you tax advice, but try to get that in writing. Is this really tax advice? I mean, whether it's your advisor, whether it's your CPA, is this tax advice? Because they'll always say, no, don't hold me to it. I don't want to get in trouble. And the problem is your friends, your relatives. We had a client I were working with and trying to get the tax advice and help him to save money. And he said, I think I want to talk to my son before I make a decision on saving this money in taxes. And Dana and I are shaking our heads like, oh, is he a CPA? Is he an accountant? Is he a tax attorney? No, it's just, I want this bias. This is different. This is new. And I'm not, I respect him. And what does he do? Yeah, he's in technology. He does some programming things. So what does he know about taxes? I mean, last time you paid your taxes, did you ask him before you write a check? Yeah, you're asking the wrong people. It's great to have advice from friends and family and things like that, but you should always measure with somebody as a professional that actually understands the system and is going to put their name behind it. I mean, when Daniel gives you tax advice, it's actual tax advice and it's in writing and says, okay, I take responsibility for this advice as a fiduciary, because when I give you advice, I'm doing this in your best interest, not because I heard some TikTok video say this is a really cool thing. And I kid you not, he's my son, right? And I love him, and he's a great attorney. And I'm watching these TikToks and Instagram things and videos, and I'm always sending him these things. What about this? Can people really save money on taxes like this? He's shaking his head. His dad, look, this is so wrong. The IRS will get you for this.
Exactly.
There's so much bad advice out there, guys. Everybody can shoot a video and put it up there, and nobody really cares because nobody gets in trouble.
And sometimes not even on TikTok. Sometimes you see it from actual advisors that mean well, but they may not be tax attorneys. They don't have a very specific tax background. So we were hearing just the other day, and this is from an otherwise well-respected advisor. Is very successful, has a lot of clients, and I'm sure does really great work for certain pieces of the retirement picture. But on this tax piece, he said something to the effect of,
you really need to buy this annuity, because if you buy this annuity, then your spouse will not have to have to take it all out within 10 years if you die.
So he's saying, if you die with an IRA and you leave it to your spouse has to liquidate within 10 years. But that's not true. The new law does talk about a 10-year schedule for inherited IRAs, but that's for your kids and your grandkids and your cousins and your friends. If you leave it to your wife
or your husband,
it makes it their IRA. So they treat it just like their own, and they can stretch out those over their lifetime.
So there's no 10-year rule for that.
Right. So if you want to get an annuity, great. I mean, maybe it's good for you, but not for the tax purpose. If it's already an IRA, there's no extra thing that you're getting for tax benefit by having an annuity or any type of investment, specifically in the IRA. And keep that in mind. That 10-year rule, the new Secure Act coming in place. And we often say on this program that one of the worst things you can leave to your kids right now under the current tax laws is an IRA that,
unless it's Roth,
that has not been converted to tax-free,
right?
Either Roth or life insurance. But if you leave it to your spouse, which, most people have their spouse as the first beneficiary. So you don't have to worry about it until the second spouse dies, because when the first spouse dies, the surviving spouse receives that IRA, makes it their own account. I have a client that this happened to. His wife unfortunately passed away last year. And so a couple months later, he was able to transfer her 401k and IRA into his own name. It doesn't even say inherited IRA on the title of the account anymore. It's his name is on it. It's an IRA. It's a regular IRA. It's not a beneficiary IRA. So the 10-year rule does not apply to spouses. And that's an example of one piece of bad tax advice that we've heard. Again, this one wasn't even on TikTok. This was a well-respected advisor that has been in the industry for many decades, and probably, I would have
well intentioned,
very well intentioned, but also very well qualified to talk about the market, to talk about protection, to talk about certain retirement strategies. There are many people in those areas, but there are very few that are also tax attorneys, and that is one thing that makes Higher Ground unique. So make sure you test everything that you hear. Don't take my work for it either. Look it up, research, make sure we're telling you the right thing. As we, as it says in the Bible, those Bereans that kept reading the Bible, make sure what Paul's saying, is this really true? Is this actually there in the Bible?
Test everything.
So, test everything. Make sure it is, but talk to a tax attorney. So when you go to our website, riskfeestaxes.com, you'll be able to talk to us, not just the retirement planners, but also the tax attorneys, to get a full picture on how to reduce those three killers, which are risk, fees, and taxes.
And just for clarification, there's no cost to this. You sign up for an appointment. It's absolutely free. You get to ask your questions and find out if we can help you. We'll find out what we can do to help you. And you're not going to be charged for this. And you don't even have to pay for gas. You just do it online.
Yes, it's all virtual. We only meet with clients virtually. So we have clients all over the country, but they're always met on Zoom or Google Meet, some platform like that.
And we've had people in this DC area actually refer people in California or Arizona or Florida to us, because we are nationwide and we can help people just in any state.
All right, so go to our website, riskfeestaxes.com, to learn more. We'll talk to you soon.